All right. So today we are going to be having, hopefully we'll be able to complete the outstanding scope on the explanation of capital budgeting concept. All right. In our last class, I introduced capital budgeting to you. We discussed the procedures involved in capital budgeting decision. We talk about the characteristics of capital budgeting. Then we'll move to discussing the methods of project evaluation, under which we dissected discounted cash flow method, where we discussed net present value and then internal rate of return, as well as the areas of conflict between NPV and the internal rate of return, as well as how to resolve the conflicts between the two techniques. So this is where we stopped in our last class. So today we are going to be discussing the other part of discounting method, which is the non-discounted, all right, non-discounted cash flow method. Okay, so the non-discounted cash flow method is a technique that does not consider the timing of cash flow and time value of money. This is a method. This is a method that does not consider the timing of cash flow and time value of money. That is, it's a method that does not make use of a discounting. It is also known as traditional method of investment appraisal. Traditional method of investment appraisal. The techniques under under non-discounted cash flow method include, okay, we have payback period. What do you mean by payback period? The payback period represents the period, usually expressed in years, in which it takes cash inflow to equate cash outflow in capital investments. The payback period is a measure of liquidity. That is, how soon can a company recover or recoup the amount invested in a project. So when calculating payback period, cash flow should be used. All right. Oftentimes, examiner can give to you accounting profit. So you don't use accounting profit to calculate payback period. It has to be cash flow. So if cash flow is given to you, you have to convert it to accounting profit before calculating your payback. Yes, Matthew, what's your question?
Okay, sir. It's on the techniques. You say the payback period is non-discounted cash flow. I'm trying to understand, sir. Like in payback period, don't we use the discount factor to get the PV before we do the summation, the accumulation to know the year it falls? I'm
We
trying to.
don't use, it's a non-discounted, you don't discount cash flow under traditional method. All right. Okay. It is only under discounted method that you use cost of capital to discount cash flow. For the that, as the name implied, non-discounted, it means that you are not going to discount the cash flows. You don't use cost of capital here. All right, Matthew.
Okay, sir.
All right. So, how do you compute payback period? How do you calculate payback period? Let me change this one. Calculating payback period. How do you calculate payback period? Payback period can be calculated. Let me give you payback period. Let me remove both. Payback period can be calculated as follows. Depending on whether or not regular cash flow, regular or constant cash flow is given. Okay, so how do you calculate payback period? The information given to you in the question will tell you, all right, how to calculate the payback. If in the question you are given constant cash inflow, all right, then in that case, where constant cash inflow, or what we call regular, all right, cash inflow is given to you, then payback period is the ratio of cash outflow to cash inflow. All right, for example, let's say, let's say you are given a cash flow, you are given initial outlay to be 100,000 naira. This is the amount the company wants to invest on a project. You are also given cash inflow of 40,000 naira per annum. And you are told that the useful life of the project useful life is 3 years. Okay. So this is the information you are given, and you now want to calculate payback period. Of course, in this case, payback period would then be equal to, you want to recover this 100,000 naira. You want to know how long will it take this project to pay back the 100,000 naira invested. So to do this, you are supposed to divide the cash outflow, the amount you have invested in the project. You are supposed to divide it with the cash inflow that the project will generate. So that will give you around 2.5 years to recover the initial investment. So in this case, my payback period will just be equal to 100,000 naira. Okay, 100,000 divided by 40,000. So that will give us 2.5 years. So whatever the answer you get, you are supposed to express it in years. All right. So this is how to calculate payback period, where you are given constant cash inflow. Year 1, it is 40,000. Year 2, 40,000. Year 3, 40,000. So because my cash inflow is regular, is constant, then I don't have to use table. I will just apply this formula and I will get my final answer. All right. So this means that this project will pay back within 3 years, or you can just say 2.5 years. All right. Then the second one is where you have non-constant or irregular cash inflow. Okay, where you are given non-constant or irregular cash inflow, where your cash inflow are different for each year, then in that case, you cannot use the formula. You have to use the tabular method. So let's say, for example, in the first year, you are given cash, you have cash inflow of 40,000. In the second year, you have cash inflow, let's say 30,000 naira. Then in the third year, you have cash inflow of 40,000, or let's say 50,000. All right. So this is the information given to you. Examiner will only give you this part. All right. Therefore, to now calculate payback period, you are going to apply this table. This is the table you are going to use. So all you need to do is to just create additional column for the balance. So it is this balance you want to use to recover the initial investment. So you are starting from year 0. The amount you have invested is 100,000 naira. You then go to the, remember we said that payback period is the period usually expressed in years, in which it takes cash inflow to equate cash outflow in capital investment. You want to know how long will it take the project to recover the initial investment. So you are using the cash inflow to recover the to recoup the initial investment. So in this case, I will then carry my calculator. 100,000 naira minus 40,000 naira will give us 60,000 naira at the end of year 1. So this simply means that we have recovered 40,000 naira. We have a balance of 60,000 naira to recover. Then 60,000 minus 30,000. This will give us 30,000 naira. So this means that at the end of year 2, we have recovered 70,000 naira. We have a balance of 30,000 naira to recover. So where your outstanding balance, where your current outstanding balance is lower or less than the next cash inflow, you then put a dash and calculate the payback period. So in this case, I need to ask myself, how many years have I recovered? I've recovered for 2 years. I've recovered 70,000 naira within 2 years. Therefore, I will then come here 2 plus the outstanding balance of 30,000 naira divided by the next cash inflow of 50,000. So that will give me the payback period. Whatever I have as my final answer, I will express it in years. So 30 over 50, all right? 30 over 50, that will give us 0.6, then plus 2, that's 2.6 years. So it will take this company, the project will pay back within 3 years, 2.6 years. So this is how to calculate payback period, where you have non-constant cash inflow. That is, where the cash inflow for each year are different. Then in that case, you apply this table. It is no more than this. This is how to calculate payback period. Now, what are the decision rule for payback period? Let me remove it from here. Okay, what are the decision rule for payback period? Okay, let me put it down here. Now, for independent projects, okay, for independent projects, you accept if payback period is shorter. Let me put it this way. Accepts if payback period is shorter or equal to, is shorter than or equal to management predetermined payback period. Okay, that's the decision where you have independent project. For mutually exclusive projects, you accept any project with a shorter payback period, provided it is equal to or shorter than the management predetermined payback period. So where two projects are where you have mutually exclusive project, two different projects, you are going to select any of the project that has a shorter or lower payback period. All right, provided it is equal to or shorter than the management targeted payback period. All right, so this is the decision rule for payback period. Note the following. Let me give you a note under this. Okay. The calculated payback period should always be compared with the management's targeted payback period. Therefore, if management's predetermined payback period is not given, there will be no basis for the acceptability. There will be no basis for the acceptability of the project. All right. So what we are seeing here is that, for example, management may say that, okay, for us to be able to undertake this project, we should be able to recover our money within 2 years, or within 3 years, or within 5 years. So if your calculated payback period meet up with the management expectation, or if it is shorter than management's intended payback period, it means the project is financially viable. So in a question, examiner can ask you to calculate payback period, and then you'll be asked to advise whether the project is financially viable. So you can only advise whether the project should be undertaken or not if you are given management targeted payback period. So in a situation whereby you are not given management targeted payback, there will be no basis for the acceptability of the project. You don't have something to benchmark your calculated payback against, all right? Because you have to compare your calculated payback period using the or any of this, either you use tabular method or you use the formula, whichever one. So all this your calculated payback, you compare it with what management intends to achieve or intends to anticipated. All right, so if you don't have that, then there is no basis for the acceptability of the project. So take note of that. You don't compare your calculated payback with the useful life of a project. That is very wrong. You don't do that. It has to be against the management targeted payback. Okay, so like I told you last time, try as much as possible. Also under this, read about the advantages and disadvantages of payback period. So this is end of payback. It's no more than that. Of course, by the time we begin calculation, you see more of that. Now, last week we were supposed to do discounted payback, and I said this one is under the discounted cash flow method. But because you need the knowledge of payback period before I can explain the discounted payback, that's what I did not mention it. So let's quickly go through this. So the next one now is discounted payback period. Okay, discounted payback period. So the discounted payback period is similar to the normal payback period, except that the expected future cash flows are discounted to the present value equivalent before calculating the payback period. In effect, the discounted payback period uses the present value to recover the initial investment. Okay, discounted payback period uses present value to recover initial investment. Let me see if this one is adequate. This is similar to the normal payback, except that the discounted payback account for time value of money in the cash flow. Okay, let me just let me rewrite it a little bit. Let me reword it. This is calculated the same way the same way as the normal payback period, except that the expected future cash flows are discounted to the present value equivalent before calculating payback period. This means that present value is used to recover or recoup the initial investments, initial outlay or investments. Okay, so you are using present value to recover the initial investment. Let's say, for example, you want to calculate discounted payback period. Let me just copy this table here. Let me use this one as a format for you. For example, okay. All right. So the first thing you are going to do, let me remove balance, cumulatives. The first thing you are going to do when you are calculating discounted payback period is to discount. This is the cash flow examiner will give to you. Examiner, this is the cash flow that will be given to you in the question. And you are now asked to calculate discounted payback period. So the first thing you are going to do is to discount the cash flow. All right. So I will create additional column. Here will be discount factor. Let's say we have discount factor of 10%. All right. So we have a discount factor of 10%. I'll create another column for present value, PV. All right. So in this case, discount factor for year 0 will be 1. 10% for year 1, 0.909, 0.826, 0.751. So you then multiply to get the present value. Here will remain 100,000 naira. What do you have? 40,000 multiplied by 0.09. 40,000 multiplied by 0.909.
36,360.
36,360.
24,780.
24,780. 24,780. Year 3.
37,550.
37,550.
550.
37,550. 37,550. All right. So by the time you add up all of this, it appears that it's not even up to 100,000. But again, let's push this one because examiner will give you a cash flow that will be sufficient for you to calculate your payback. Let's increase this one to let's leave this one as 50. Let's increase this one to 60. So multiply 60 multiplied by 0.826. What do you have?
49,560.
49,560. All right then. So what we are now saying is that as far as discounted payback period is concerned, so instead of you to use, the normal payback period, we use the cash inflow to recover the initial investment. Now that you have discounted cash flow, it means that you must first of all discount this your cash inflow. You discount it using the appropriate cost of capital to arrive at the present value. So you then use this present value to recover the initial investment. Therefore, 100,000 minus 36,360, what do you have?
63,640.
63,640 minus 49,560.
14,080.
14,080. All right. So you notice that 14,080 is less than the next cash inflow. You then put a dash. You calculate your payback period. Therefore, let me copy this. All right. So I would then ask, how many years have I recovered? I've recovered for 2 years.
Yes.
At the end of year 2, we have a balance of 14,080. Therefore, here will be 2 plus the outstanding balance of 14,000. 14,080. All right. Then divided by the next cash inflow of 37,550. So 14,080 divided by 37,550 equal plus 1 equal. So this will give us what?
0.37.
2 point.
0.37, 0.38.
Have you add 2 plus 4. 2?
Yes, I get 2.4. Approximately
2.37.
2.37 years. So this is how to calculate discounted payback period. That's how to calculate discounted payback period. So let's move on from here. It's as simple as, yes, Evelyn, you'll be raising hand. What's your question?
Yes, sir. Please, before this one we just did, please can you take it back to that, the very last one we did before this one? We were saying, when you were talking about if they did not give you a basis, there's nothing to compare it with. So if you are to advise, what will you do there? Are you going to just say there is no basis, or you say accept or reject? I don't know.
You
Because you said
cannot
if there's no
advise.
basis.
If you are
Okay,
not
fine.
given management targeted payback, there's no way you are going to accept, you are going to advise. This is what you are going to say. Let's say, for example, you have calculated the payback period and the answer is 2.6 years. And in the question, you are not given management targeted payback period. So what you are going to say is that this project will pay back within 2 years or within 3 years or within 2 years and 6 months. However, since management targeted payback period is not given, there is no basis for the acceptability of the project. That's all. That's what you are going to say.
Okay.
Because you
Thank you.
must have, for you to be able to advise whether the project should be undertaken or not, you have to compare your calculated payback period with the management targeted payback. So since it is not given, then there is no basis. Next one. So let's move to accounting rate of return. Okay. So what do you mean by, let me reframe this one completely. So what do you mean by accounting rate of return? This is also known as return on investments or return on capital employed. Return on capital employed. It is a technique. It is a technique that relies heavily on accounting information as shown in the financial statements of a company. Okay. Accounting rate of return is a measure of profitability. Accounting rate of return is a measure of profitability. Unlike payback period that measures liquidity. Okay, I have to be faster so that we get all the story today, all the underlying concepts. All right. Matthew, what's your question quickly?
Okay, thank you, sir. Sir, for payback period, will it now be right to say that payback period falls under discounted rate and non-discounted, fall under discounted technique and non-discounted technique? Looking at the technique of calculation of the
What do you
calculation,
mean by payback period falls under discounted and not discounted?
because it's like for this one we just did now, we have discounted payback period and we have normal just payback period. So that's what I'm trying to
I
see
told
whether.
you, hold on, Matthew. Before I started discounted payback period, I told you that discounted payback period is under the discounted cash flow method. But and I told you last week that we did not do it because I wanted us to do the normal payback period before we are going to discuss. I mentioned it some minutes ago. This is not part of non-discounted. This is under the discounted cash flow method. If you look at what we did last week, you will see it there. Let me show you. Let me go back to see it there. It's under the discounted cash flow method. So it's because we have not done you need the knowledge of payback period before discounted payback period. That's what I did not mention it last time. Is it clear to you now, Matthew?
Yes, sir. Thank you, sir.
Emeka, what's your question?
Good evening, sir. Please, I joined the class like 5 minutes ago. I wanted to know how you got that formula for discounted rate of return. The formula, that 2 plus.
The formula.
Yes, sir.
Which
Like when
formula?
Discounted rate of return. When you were
Discounted
solving,
rate.
it said 2 plus brackets,
It's not a
figure.
formula. It's not a formula. It's not a formula. We are just recovering the amount. See, this is not a formula. We are calculating payback. You have recovered 40,000. You have recovered 30,000. How many years did you recover that? This 40,000 is for year 1. 30,000 is for year 2. So you have recovered for 2 years. That's why you are seeing this 2 here. Plus the outstanding balance at the end of year 2 divided by the next cash inflow. So it's not if you call it, it's not a formula, but it's just a method of solving it. All right?
Very much, sir.
Now, so like I was saying, accounting rate of return is a measure of profitability. Therefore, when calculating accounting rate of return, when calculating accounting rate of return, accounting profits or loss should be used if cash flow is given, it should be converted to accounting profits. Should be converted to accounting profits or loss before calculating ARR. So that's the key thing you need to know. Of all investment appraisal techniques, only the accounting rate of return uses accounting profits. Okay? Every other techniques uses the cash flow. Every other technique uses a cash flow. So you need to read about advantages and disadvantages of accounting rate of return. Before we begin to talk about decision rule, you need to know about how to calculate accounting rate of return. So to calculate accounting rate of return, there are 4 steps you are supposed to carry out depending on the information available in the question. Okay, there are 4 steps you are supposed to carry out. Let me rewrite this one. Calculating accounting rate of return. Calculating accounting rate of return. So like I said, to calculate accounting rate of return, there are 4 steps. The first thing you are going to do, in most cases, if examiner wants you to calculate ARR, you are going to be given cash flow. Examiner will never give to you accounting profit or loss. You are not going to be given accounting information. You will be given cash flow in most cases. Therefore, you need to convert the cash flow to profit or loss. So to do this, the first step you are going to do is to calculate annual depreciation. All right, so you calculate annual depreciation. So how do you calculate annual depreciation? The annual depreciation is the initial cost of the project. All right, the initial investment minus the scrap value divided by the useful life of the project. What is the cost of the project? How much is the company going to earn when it disposes of the project at the end of the useful life? All right, then divided by the use. So this will give you the annual depreciation. Once you have the annual depreciation, the next thing you need to do is to then calculate average annual profits. Okay, so you calculate average annual profits. Average annual profits, AAP. So to calculate average annual profits, you are going to pick the cash flow of each year. All right, you take the cash flow of each year, you then deduct depreciation of annual depreciation you have calculated in step 1. So you deduct depreciation divided by the useful life. So that will give you the average annual profits. If you don't want to follow that out, it is when you add up the difference between the cash flow, cash flow and depreciation will give you profits. So you are going to add up profit for all the years. That will then give you the total profits. Okay, this will give you total profits, then divided by the useful life. Divided by the useful life. So that will then give you the average annual profit. Once you have average annual profit, then step 3 is to then calculate average investments. Okay, you then calculate average investments, AI. So average investments is computed as the initial cost of the project plus the scrap value divided by 2. So that will give you the average investment. Once you have that, then finally you can then go ahead to calculate accounting rate of return, which is average annual profits divided by average investments. Okay, AAP divided by AI. So that will give you the accounting rate of return. You have to multiply your final answer with 100%. Your final answer must be in percentage. So this is how to calculate accounting rate of return. So what are the decision rules for accounting rate of return? Number A, for independent projects, you accept if accounting rate of return is greater than or equal to management predetermined ARR. Okay? ARR. That's for independent projects. So for mutually exclusive projects, you accept any project with a higher accounting rate of return, provided it is greater than or equal to management targeted ARR. Okay, so that's the decision rule for accounting rate of return. When you look at this, you will notice that all the non-discounted cash flow techniques are compared. Compare the calculated figure with the management targeted figures. All right. So payback period, you compare your calculated payback period with management targeted payback period. Under accounting rate of return, you compare your calculated accounting rate of return using the ARR formula. Okay, you compare that with the management predetermined ARR. So this is what you are going to do under the non-discounted cash flow method. All right. Finally, before we move to relevant cash flow, all right, what are the criteria? Okay, so this is the way to calculate accounting rate of return and then in effect, the payback period. Now, the next thing we want to do, examiner can ask you to explain or discuss criteria, factors, or determinants of financial viability or determinants of project evaluation. What are the variables that must be present, or what are the requirements? What are the basic requirements for project evaluation? The question can come in any form, but you have to know what you are doing, right? So examiner can ask you what are the variables that must be present when evaluating a project, or what are the basic requirements for project evaluation, or what are the criteria, factors, or determinants of project evaluation. Okay, so there are 3 items. Let me give it to you. Let me start from, okay, let me just marry everything. Let me start afresh, or let me start from here. Criteria, get out. Criteria / factors / determinants of project evaluation, or examiner can say of determining financial viability of a project. So what are the determinants? Let me show you. Now, when evaluating a project, what's wrong with you? When evaluating a project, okay, when evaluating, what's wrong with you now? Be careful. Wasting my time. So when evaluating a project, the following variables must be present. Or let me put it this way. The following are the basic requirements. The following are the basic requirements for projects evaluation or for determining financial viability of a project. So now, anytime you want to evaluate a project, there are 3 variables that must be present. The first one is useful life. Let me start with useful life so that I can use the last one. I can explain the last one in more details. Okay, the first one is useful life. What do you mean by useful life? Okay, let me number it. All right. So what do you mean by useful life? Every project must have a useful life. Every project must have a useful life, and it will vary depending on the project size. Depending on the project's size. A large project will have a longer useful life relative to a smaller project. All right, relative to a smaller project. Without a useful life, it will be almost impossible to incorporate the concept of time value of money. So, time value of money will allow you to discount a project. So if you don't know the useful life of the project, how will you be able to know when to discount it? All right. So that is the usefulness or the essence of useful life. Every project must have a useful life. Okay. That's number 1. Then number 2, appropriate cost of capital. Appropriate cost of capital. Anytime you want to appraise a project, you are going to need cost of capital. So the cost of capital to be used to evaluate the future cash flows must be consistent with the cash flow. Must be consistent with the cash flow and project risk. Okay. So remember when we did cost of capital under project specific, we said that project specific is a cost of capital. It is computed when a company is diversifying into a new industry, because the cost of capital to be used to evaluate a project must be consistent with the project, with the systematic business and financial risk associated with the project. So without cost of capital, again, it will not be possible to discount the future cash flows. Number 3, this is the main one, relevant cash flow. Relevant cash flow. All right. What do you mean by relevant cash flow? So let me take you to the next one so that I can explain it further. Relevant cash flow. These are cash flow. These are cash flows of receipts and payments. These are cash flow of receipts and payments that are directly, or let me put it this way. Okay, that are directly attributable. They are directly attributable to the project under consideration. Let me just give an intro. The cash flow to be used to evaluate a project. The cash flow to be used to evaluate a project. Or let me put it this way. The cash flow to be used, to evaluate a project must be consistent. Let me push it like this. All right. The cash flow to be used to determine financial, to be used to determine the financial viability of a project must relate must relate to the projects under consideration. Okay. Relevant cash flow. Relevant cash flow relevant cash flow are receipts and payments. Relevant cash flow are receipts and payments that are directly attributable to the projects. All right. So attributable to a particular course of action. Well, let me use that. To the project. When evaluating a project, the following line items must be critically examined. Okay. Now, on the day of your exam, let me call that one back. So on the day of your exam, right? Examiner will give to you different cash flows. So you have responsibility to be able to identify which of the cash flow given to you are relevant, which one is not relevant. Like in November 2025 diets, a question was tested under capital budgeting, compulsory question number 1, 30 marks. All right. So you have responsibility to be able to deduce or to determine which of those cash flows given to you are relevant, and then which one is not relevant. Now, what I'm trying to do here is that I'm using one stone to kill two birds. All right, I'm using one stone to kill two birds. I want to explain I'm explaining the criteria or determinant of project evaluation, which are 3, like I mentioned. The first one is useful life. The second one is appropriate cost of capital. And the third one is relevant cash flow. So on the day of your exam, if you are asked to explain or to discuss the basic requirement for project evaluation, so you just talk about the useful life, the way I've done it. You can also flesh it up. You talk about appropriate cost of capital. You also talk about relevant cash flow. So what I want to say next, there is no need for you to do that. All right, you can just mention them, but no need for you to elaborate into it will be too voluminous. All right. Now, so on the day of your exam, you are going to be given different kinds of cash flows, both relevant and irrelevant cash flow. So you have responsibility to be able to deduce of all the cash flow given to you, which one are relevant, which one are not relevant. So you need to know about variable cost. What is variable cost? How do you identify variable cost in a question? You need to know about our fixed cost or fixed overhead. All right. You also need to know about, you also need to know about what do you do with direct / incremental / attributable / specific fixed cost. How do you treat it? All right. So all of this you need to know. You need to know about depreciation or amortization or provision. How do you treat it? Right? How do you treat interest in a question? When you are given interest, how do you treat it? How do you treat historical costs? Let me push this one up there. How do you treat historical costs? Historical cost, right? So I will make working capital to be the last one here. Okay, so let's pick it one by one. The first one is variable costs. Variable costs are costs that vary according to activity level. Let me write it. These are relevant costs that are, no, let me change it. Okay, let me change it. These are costs that change according to activity level, or production volume, Okay, examples include, let me write this. Examples of variable costs. Example of variable costs include direct material. When you see direct material in a question, you pick it. Direct material, direct labor, direct expenses, or variable overhead. All right. So these are examples of variable cost. Variable cost is also known as direct cost or marginal cost. So When you see variable cost in a question, it is relevant. You have to consider it. So variable cost is a relevant cash flow and should be considered. Okay. When you see variable cost in a question, you have to take it. It is relevant. Next, fixed cost or fixed overheads. Okay, fixed cost or fixed overhead. Fixed costs are costs that have no sympathy for activity level. That is, irrespective of number of units produced, irrespective of the production volume, irrespective of the activity level. Fixed costs do not change. Okay, fixed costs do not change. Okay, except it is incremental in nature. Fixed costs do not change except it is incremental in nature. So only incremental fixed cost is relevant. Therefore, fixed cost is irrelevant and should be ignored. Fixed cost. Therefore, fixed cost is irrelevant and should be ignored. I don't need this one again. All right. So when you see fixed cost in a question, you have to ignore it. Except you are told that it will change, except if it will change. All right, as a direct consequence of the decision taken. Next one would then be directs. How do you treat directs, incremental, attributable fixed cost? Okay, let's talk about that. These are relevant cash flow. These are relevant cash flows and should be considered when evaluating a project. So if you are given specific fixed costs or attributable fixed costs or direct fixed costs or incremental fixed costs, so they are all relevant. You have to consider it. Next one is depreciation. All right. I don't need this again. All right. Next one is depreciation. Where is it? Okay, yeah. So next one is depreciation, amortization, or provision. How do you treat? When you see depreciation in the question, what are you supposed to do with it? This is a non-cash item. This is a non-cash item or notional costs. And does not involve the movement of cash. Therefore, depreciation is irrelevant cash flow and should be ignored. Okay, depreciation is irrelevant cash flow and should be ignored. When you see depreciation, amortization, or provision in a question, please don't use it. You have to ignore it. Next one, historical costs. Let's talk about historical costs. Let me copy this. Yeah, historical costs. What do you mean by historical costs? This is also known as, also known as sunk cost. This is also known as sunk cost. They represent the cost. They represent the costs that have already been incurred. That is past cost. That is past cost. Okay. Let me include this one. Common examples of historical costs are development costs, market research costs, market survey. You can be given market survey, or you can be given feasibility study fee. So these are examples of feasibility. These are examples of sunk costs or historical costs. All right. Therefore, sunk costs are irrelevant cash flow and should be ignored. They are irrelevant cash flow. When you are in a question, once you see any form of this, when you see anything relating to development costs, right? Market research costs, except if the development cost has not been incurred before the project commences. So if it will be incurred because of the project, then it is relevant. But in most cases, the market research cost or market survey cost or feasibility study cost are usually incurred before the project begins, and that's why they are historical. So when you see it in a question, you have to ignore. Next one is interest. What do you mean by interest? Interest is a compensation for the use of funds for a specific period of time. It is the amount charged expressed as a percentage of principal by a lender to a borrower for the use of assets. So the interest you pay on the loan borrowed is known as it's a specific percentage on the amount of loan borrowed. That is interest. Now, the usual is that on the day of your exam, you may be given the absolute amount of interest. So the naira amount of the interest is irrelevant. Why? Because the cost of capital you are supposed to use to discount the future cash flows already included interest. You will recall when we had cost of capital, we calculated cost of equity, cost of preference share, and then cost of debt. When we calculated cost of debt, we use interest. So because your work already included interest, so the naira amount of interest, for example, if you are given interest of 100,000 naira, so that 100,000 naira is irrelevant because the cost of capital you are going to use to discount the cash flow already included interest. So if you now consider the naira amount, that means you are double dipping. You are treating interest twice. Okay, and that is why anywhere you see interest in a question under capital budgeting, you ignore it. So let me check the appropriateness of the comment here. Interest should not be considered while determining relevant cash flow because it has already been incorporated in the cost of capital. And doing so, we amount to double dipping. That's fine. All right. So the next one is opportunity cost. Opportunity costs. Opportunity cost is the benefit forgone as a direct consequence of the decision taken. This is an alternative given up. Let me reframe this. I don't need to write too much notes. This is a benefit. This is a benefit foregone as a direct consequence. This is a benefit foregone as a direct consequence of the decision taking. All right. Opportunity cost is a relevant cash flow and should be considered. That's it. When you see opportunity cost in a question, you have to consider it. So I'm going to flesh the next one, and the last one is working capital. When you see working capital in a question, what do you do with it? First thing first, what is working capital? All right. This represents the difference between current assets and current liabilities. Okay. It involves, or it is the amount required for the day-to-day running of a business. So company will need money to pay salary. You need money to buy supplies and other stationaries. You need money, company will need money to settle short-term obligations as they become due. So you need working capital to do that. All right. So working capital is a relevant cash flow. In the determination of relevant cash flow, working capital should be considered. Okay, that's okay. Working capital should be treated. Okay, let me reword this. Treatment of working capital. Treatment of working capital. There is no way you are going to have capital budgeting question, a complete capital budgeting question, that you are not going to be given working capital. So you have to know how to treat working capital in a question. All right, so how do you treat working capital? Number A, one of working capital. Let me do it this way. So when you are given a one-off working capital, how do you treat it? All right. This should be treated. This should be treated as a cash outflow, in the year before the year of occurrence, and recover fully at the end of the useful life. Okay, so that is how to treat a one-off working capital. It should be treated as cash outflow in the year before the year of occurrence, and then recover fully at the end of the useful life. All right. For example, okay, for example, let's say you are given a working capital, right? You are given a working capital of you are told that a project will incur working capital of 10,000 naira in year 2. A working capital, let me put it as a word, a working capital of 5,000 naira will be incurred in year 2. Let me put it this way. A project with a useful life, a project with a useful life of 3 years, is expected to incur a working capital of 5,000 naira in year 2. All right, in year 2. This is the information given in the question. We are told that a project with a useful life of 3 years is expected to incur a working capital of 5,000 naira in year 2. So because this 5,000 naira will only occur once, so that's a one-off working capital. So how do you then treat a one-off working capital? So the useful life of this project is 3 years. Therefore, I will create a table, right? I will create a table. Let me create a table to solve this, to demonstrate for you how to do it. Okay, so I will create a table. Let me put additional column. All right, so I will create a table for each year. This will be for year 1, year 2, then year 3. So here will then be my working capital. So in the year 2, we are told that this project will incur a working capital of 5,000 naira in year 2. So the rule says that working capital should be treated as cash outflow in the year before the year of occurrence, and then recover fully at the end of the useful life. So because this 5,000 naira is incurred in year 2, so I'm not going to record it in year 2. Year before year 2 is year 1. So I will then come here, 5,000 naira. So it will be accounted for in year 1, because year 1 is year before year 2. So it should be treated as cash outflow. I'll put it in brackets. Then at the end of the useful life, in this case, useful life is 3 years. I have to recover the entire working capital. So what this simply means is that your working capital must equal to 0. All right. The only difference is just that by the time you discount the cash flows, discount factor of year 1 will always be different from the discount factor of year 3. For example, that means the present value of this cash flow in year 1 will be higher than the present value of what you are going to get in year 3. All right. So this is how to treat a one-off working capital. One-off simply means it will occur only once. So it should be treated as cash outflow in the year before the year of occurrence, and then recover fully at the end of the useful life. So the second one is incremental working capital. How do you treat incremental working capital? Okay. Incremental working capital. This is treated the same way as a one-off working capital, except that only the increments is considered. All right. So the same way you treat a one-off working capital is the same way you are going to treat an incremental working capital. All right. However, only the increments you are going to consider. Let's say, for example, in a question, all right, let me use this table. let's say you are given working capital information in a question. For year 1, for example, you are given working capital of 1,000 for simplicity. Year 2, you are given working capital of 1,200. Year 3, you are given working capital of 1,500. So once you see that your working capital is not the same for all the years, and not only that, your working capital has increased from the first year, between the first year and the final year. If your working capital has increased between the first year and the final year, it means that, of course, that is an incremental working capital. So in this case, this is not what I'm going to use. This is what examiner will give to you, but this is not what you are going to use for your evaluation. So you then pick the figure that I'll be giving to you. The first thing you need to do is to determine the incremental working capital. So you determine the incremental working capital. How do you do this? The first one is 1,000. 1,000 has increased to 1,200 by 200. 1,200 has increased to 1,500 by 300. Okay, so that is the incremental working capital. You then create additional column for total. Okay, you create additional column for total. Under total, by the time you add up 1,000 plus 200 plus 300, that will give you 1,500. Then finally, you need to state, if necessary, you need to state relevant year. What do I mean by this? The rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. So the working capital of 1,000 naira in year 1 should be treated as cash outflow in year 0. The working capital of 200 naira at the end of year 2 should be treated as cash outflow in year 1. The working capital of 300 naira at the end of year 3 should be treated as cash outflow at the end of year 2. Then at the end of the useful life of the project, which is year 3 in this case, you need to recover the entire working capital. So when I'm doing my calculation of NPV, this is what I'm going to recognize for each year. For year 0, year 1, year 2, year 3. This is what I'm going to recognize. This is what is known as, this is how to treat incremental working capital. It can come in any form. All right. In most cases, examiner will not give it to you. They will just tell you that working capital in the first year is 100,000 naira, and this will increase by 5% per annum. So in that case, you need to increase it. You need to first of all increase it before you now determine the incremental working capital. So don't worry, as we progress, when we begin calculation, you will see all of this. All right. But for now, just know that you just have to know how to treat working capital. Okay. So that is as per that. The last area we are going to discuss will then be impact of inflation and taxation. Okay, so we're starting with impact of inflation. Let me know if you have any question for me. Somebody is sending me chats. I'm just reading it now. Sir, what happens if under mutually exclusive project like ARR of the two projects, the two projects is not up to predetermined? If the two of them is not up, that means they are not viable. Just ignore. You calculate accounting rate of return, and your ARR is lower than the management targeted ARR. That means they are not viable. You are not going to undertake any of the two. That's all you are going to do. Kayode, I'm responding to your chat. Yes, Evelyn, talk to me.
Yeah, please, this relevant here, can you throw more light on it? I didn't understand it.
It is the year when you are calculating, that's what you are going to do. You do for starting from year 0. That's where you have your initial outlay. All the cash flow has given to you. So it represents it year by year. So these are the years that you are going to use when you are doing your calculation. All right. So the next thing we are going to discuss is impact of inflation in capital investments. Okay. Impact of inflation or effect of inflation. Effect of inflation in investment appraisal. All right. I'm not going to be telling you the definition of inflation and all of that. That is not important here. You can read it. However, for the purpose of inflation, there are two types of cash flow. All right. For the purpose of inflation, there are two types of cash flow. The first one is money cash flow. The second one is real cash flow. What do you mean by money cash flow? Money cash flows are cash flows that incorporate or that include the possible effect of inflation. These are cash flows, all right? These are cash flows that incorporates the possible effects, all right? The possible effects of inflation. Unless otherwise stated, all cash flows are assumed to be money cash flow. So if in a question, you are just given cash flow, your examiner did not tell you whether it is money cash flow or real cash flow. So you are going to assume it is money cash flow, all right? You are going to assume it is money cash flow. If examiner wants you to do something, they will tell you that it is real cash. They won't even say it is real cash flow. There is a way they are going to design the question for you to know it is real cash flow. All right. So money cash flow are inflated cash flow. They are inflated. They are already inflated cash flow. That is, money cash flow already included inflation cash flows. Okay. Now, what do you understand by real cash flow? Real cash flow are cash flow that do not consider the possible effect of inflation. These are cash flows that do not consider the possible effect of inflation. They are cash flow stated, okay? They are cash flows stated in today's prices, stated in today's prices. Let me start from there. Stated in today's prices, year zero prices, first year prices, all right, year zero prices, first year prices, first year prices, or current value times, current value times. Okay. So once you are given a question, an examiner tell you that, for example, selling price today is 800 naira. Because the examiner has mentioned today, it means it's a real cash flow. Again, examiner can tell you that variable cost is currently 1,000 naira. Because the examiner has mentioned currently, it means that it is real cash flow. So real cash flow are cash flows that do not consider the possible effect of inflation. They are deflated cash flow. They don't include, real cash flow does not include inflation. All right. Therefore, how do you convert money cash flow to real cash flow or real cash flow to money cash flow? Let's quickly discuss that. All right. So ordinarily, we don't use this when you are doing your calculation. It's just for knowledge sake. It doesn't, it is implied that you know what you are, by the time you begin calculation, you are not going to use any of this formula for anything. But in any case, if you want to convert real cash flow to money cash flow, you know, we said that money cash flow include inflation. Real cash flow does not include inflation. Therefore, you want to convert money cash flow, you want to convert real cash flow to money cash flow. What are you supposed to do? That means, remember, real cash flow does not include inflation. You now want to convert it to money cash flow. That means you are going to inflate. Okay, so like I was saying, if you want to if in the question you are given real cash flow, you now want to calculate money cash flow. So how do you convert real cash flow to money cash flow? So to do this, you are expected to compound, you are supposed to increase the real cash flow as given to you. To do that, you are going to multiply the real cash flow given to you with 1 plus inflation rate, all right? Then raised to power n. When you do this, that means you are compounding the cash flow. So that is how to convert. In most cases, this is the formula you are going to use when you are evaluating the project, if inflation is given. All right. Then the next one is to convert money cash flow to real cash flow. Remember, money cash flow already includes inflation. Real cash flow does not include inflation. So you want to remove inflation from the money cash flow. So that means we are going to make real cash flow the subject of the formula. So in this case, money cash flow will then be equal to, I can also rewrite this formula. Let me use this. All right. So real cash flow, real cash flow will be equal to money cash flow multiplied by 1 plus inflation rates raised to power minus n. All right, raised to power minus n. Minus n. Why is this one not showing minus n? Let me see. Anyway, this one is not showing minus n. Don't waste my time. All right. So, or you just say money cash flow divided by 1 plus inflation raised to power n. When you do this, you are going to get the real cash flow equivalent. All right. So that is how to convert money cash flow to real cash flow or real cash flow to money cash flow. However, at year 0, right? At year 0, money cash flow and real cash flow are equal. Remember, anything raised to power 0 is equal to 1. So money cash flow will be equal to real cash flow in year 0. So I'll just say real cash flow multiplied by 1 plus I raised to power 0. So that means the two of them will equal. All right. So like I said, you don't need this in anything. You don't need it for anything when you are doing your evaluation. You don't need it. But at this level, what you need to know what is the meaning of real cash flow. What's the meaning of money cash flow? Examiner can ask you. All right. So you need to know it. Then finally, in this aspect, for the purpose of inflation, there are two types of cost of capital. All right, there are two types of cost of capital. We have money cost of capital, then we also have real cost of capital. What do you know? What do you understand by money cost of capital? This is also known as nominal cost of capital or money rate of return. It is the cost of capital that incorporates the possible effect of inflation. All right. So it is the cost of capital that incorporates the possible effect of inflation. All right. So except otherwise stated, the cost of capital given in the question will represent money cost of capital. If in a question you are just given cost of capital, examiner did not tell you whether it is real or money cost of capital, you are going to assume it is money cost of capital. If examiner wants you to do something, they will tell you it is real cost of capital. So that means you need to calculate money cost of capital. All right. So that is as per that one. Then the real cost of capital is a discount rate that does not include the possible of inflation. It is cost of capital that is stated in real terms. All right. It is the cost of capital that is stated in real terms. All right. So that is as per that. Now, how do you estimate money cost of capital, real cost of capital, or general inflation rates? To calculate, for the purpose of inflation, to calculate money cost of capital or real cost of capital, you are supposed to use Professor Ivan Fisher effect formula. Okay, Ivan Fisher effect formula to calculate your money cost of capital, real cost of capital, and general inflation rate. Okay, according to Professor Ivan Fisher, 1 plus money cost of capital is equal to 1 plus real cost of capital multiplied by 1 plus general inflation rates. Okay. Now, from this original formula, you can generate your money cost of capital, real cost of capital, and then inflation rates. So if I want to calculate money cost of capital, for example, which is denoted as M, let me define it here. Okay, let me just copy this and push it up. Okay. So M is money cost of capital. R is real cost of capital, then I is general inflation rate. So from this original formula, if I want to make M the subject of the formula, all I need to do is to push this one behind M. I'll push it to the other side. So that means money cost of capital will be computed as 1 plus real cost of capital multiplied by 1 plus inflation rate, all minus 1 will give me the formula. This is the formula for calculating money cost of capital. If I want to make R the subject of the formula, I want to calculate real cost of capital. That means I have to divide both sides by 1 plus I, because this 1 plus I is disturbing 1 plus R. Therefore, I have to divide both sides by 1 plus I. So to do this, I will then pick money cost of 1 plus money cost of capital divided by 1 plus inflation rate, all minus 1. So this is the formula for calculating real cost of capital. Then, if in the question you are given money cost of capital and real cost of capital, but you don't have general inflation rates. So to determine general inflation rate, what are you supposed to do? The same way you calculate real cost of capital is the same way you are going to calculate general inflation rate. So to do this, you are going to divide 1 plus money cost of capital divided by 1 plus real rate of return, all minus 1. So this is the formula for calculating general inflation rate. Please, you have to master the formula for calculating money cost of capital and real cost of capital, because you don't know where examiner is coming out to you. So that's why you just have to master them. Okay, it's very straightforward. It's simple. Okay. Now, under inflation, you need to understand the general rules, and you have to apply the rules when you are doing your calculation. All right. The first rule is that cash flow stated in money or nominal terms must be discounted using money cost of capital. Cash flow stated in real terms must be discounted using real cost of capital. Under no circumstance should you use money cost of capital for real cash flow. You should also not use real cost of capital for money cash flow. All right. This is what you have to watch out for. Okay. So what did I say? Discounting cash flow using money cost of capital and real cost of will give the same result. Okay. Money cash flow should not be discounted using risk. Real cash flow should not be discounted. All those ones are irrelevant for me. Let me just leave it there. Now, what is key when you are solving your question? You have to watch out for this. More importantly, where cash flows are stated in year 1 prices or first year prices, inflation should start from year 2, meaning that you don't inflate the first year price. You have to start inflating the cash flow from year 2. Okay, that's what you need to do. Then the second one is where cash flow are stated in today's prices, year 0 prices, current value times. Okay, current value times. Inflation should start from year 1. So, for example, examiner can tell you that selling price in the first year, all right, is 1,000 naira. So, because the examiner has told me that selling price is in first year price, therefore, I'm not going to inflate year 1 prices. I will start inflating from year 2. Let me put it here as an example so that you understand better. Let me push it to the next page. Let me give it as an example. For example, hope I still have time to explain taxation. All right, so for example, examiner can tell you that selling price in year one is 1,000 naira for simplicity. So let's say the useful life of the project is 3 years. Okay, selling price, I did not put price. Selling price in year one is 1,000 naira. This project has a useful life of 3 years. Okay, let me use this to explain. So in this case, because examiner has told us that selling price in year one is 1,000, examiner has mentioned year one. That means this 1,000 naira is in year one prices or first year prices. Therefore, what I'm going to do is that when I'm doing my working, I will create a table. Let me use table. 1, 2, 3, 4. Okay. Now, when I'm doing my calculation, when I'm doing my workings, I want to inflate this 1,000 naira. So I will then do a column for year one, year two, and then year three. I will come here, selling price. Okay. If I want to use, this is the ideal method you are supposed to use. Now, this information is not complete. Selling price in year one is 1,000 naira, and it will grow. It will grow by 5% per annum. So you have been given inflation rate of 5% per annum. This project has a useful life of 3 years. All right. So ideally, this is the way you are supposed to solve it. I would then say selling price, inflation rate is 5%. Okay. So let me adjust this one a little bit. So inflation rate is 5%. Remember what I told you earlier on when you are converting money cash flow to real cash flow to money cash flow. I said all these formulas, you are not going to need it when you are doing your calculation. All this formula, you don't need it for anything. The same thing I'm doing now. That's what I'm doing now. Now I want to convert because examiner has given to me selling price in year one price. Because examiner mentioned year one, it means that this 1,000 naira is a real cash flow. That is a real cash flow. And I want to convert it to money cash flow. So in this case, I will just carry my calculator. I don't need formula for anything. I will just carry my calculator. I will say inflation rate is 5%. Therefore, 1 plus 5% will give us 1.05. So 1.05 multiplied by 1,000. Okay, multiply by 1,000. That will give us 1,050. So here is 1,000. That's the first year price. I've increased it by 5% and we got 1,050. Then to get the year three selling price, I would then say 1.05 multiplied by what I have in my calculator. I have 1,050 in my calculator. So multiply by 1.05. So that will give us 1,103. 1,103. So with this, I've inflated the selling price. This is what you are supposed to do ideally on the day of your exam if you are doing this. However, if I want to use primary school method, alternatively, I can say I can simplify it further to say, I'm not going to use selling price. I will just repeat the entire 1,000 I have here for each year. This is the way you are supposed to do it. If you want to use primary school method, I will then introduce additional row. The second row will then be for inflation. Okay, inflation at 5%. We are given inflation rate of 5%. So this will then be equal to 1.1 raised to power minus, let me use formula here. 1.1, comma. Okay, so remember, 1 plus inflation rates raised to power n, okay? Because I'm compounding it, I'm increasing the real cash flow to money cash flow. Therefore, here will be 1.05 raised to power 0. Okay? Let me copy and paste. Then, for year 2, here will then be equal to 1. Here will be equal to 2. All right. So that's what you are supposed to do. I will then carry my calculator. 1.05 raised to power 0 will give me 1. 1 multiplied by 1,000 will give me 1,000. Then 1.05 raised to power 1 multiplied by 1,000. I will have the same thing as 1,050. Okay. 1.01 raised to power 2. Whatever I have in my calculator, I will multiply with 1,000. That will give me 1,103. So this is then my inflated, selling price. Okay, this is my inflated selling price, which I'm going to use for the calculation of my NPV. So this is what you are going to do. So whether you can see the first one is faster for me, all right? And it is the most appropriate, is the ideal method that you should adopt. You can see this one has only 2 line items. This one has 4 line items. Even though this one is more informative, the second one is more informative, but it will take more time relative to this one. Why should I be going through all of this stress when I can just use only 1 line item to get the same answer? Okay, so this is, if you are told that cash flow is stated in year 1 prices, this is how you are going to treat it. That is the essence of this my story since. Now, the second one says that cash flow as stated in today's prices. Once you are told in the question that cash flow is stated in today's prices, year 0 prices, or current value terms, or you are told that variable costs now, or variable cost is 800 naira now, or variable cost is 800 naira in current value terms. So you should know that inflation must start from year 1. Okay. Again, for example, let me just copy this. Okay. So for example, if you are told that, let me use variable cost instead of selling price. Variable costs. Variable costs is currently 1,000 naira. Okay, let's leave it at that. Variable cost is currently 1,000 naira and will increase, and it will increase by 5% per annum. The project has a useful life of 3 years. So for simplicity, let's maintain that. So I will then come here, variable cost. Variable cost. Now, because examiner has told me that this variable cost is currently, examiner has mentioned currently, that means this 1,000 naira is in current value terms. So I'm going to start inflation from year 1. So I will then come here. I can say, all right, I can say 1,000 naira, 1,000 naira multiplied by 5%. Okay. So that will then give me 1,050. Here will be 1,050. Okay. I will then say 1,050 multiplied by 0.5. All right. 1,050 multiplied by 1.05. So I get 1103. I will list, I get I got 1102.5. So when you round it, that will give us 1103. So in your what the answer you have in your calculator is what you are going to increase by the inflation rate. So what I have in my calculator, which is 1102.5, then multiply by 1.05. So that will give me 1157, 1158 rather. 1158. So this is how to inflate. When you are told that cash flow is stated in today's prices, year 0 prices or current value terms, this is how to inflate your cash flow. Inflation must start from year 1. But if you are told that cash flow is stated in year 1 prices, then inflation must start from year 2. All right. So this is the end of inflation. Finally, let's go to impact of taxation. All right, impact of taxation. How do you incorporate tax? How do you incorporate tax in capital investments? So when a company incurs qualifying capital expenditure on non-current assets, for example, company can can purchase building, right? Motor vehicle, furniture and fittings, equipment or plant and machinery. Okay, so when the company incurs qualifying capital expenditure, the company is entitled to claim capital allowance on the qualifying assets. So capital allowance is granted for a business in lieu of depreciation, because depreciation is not allowed, it's not an allowable expenses. Okay, as a result, when a company incurs qualifying capital expenditure, the company can adjust for capital allowance before paying the tax liability on the assets, on the profit of the company. Now, the primary purpose, okay, before that, there are reasons or purpose of incorporating tax in capital investments. Okay, what are the reasons? Let me just reasons or purpose of incorporating tax. Okay, of incorporating tax in capital investments. There are 3 reasons. The first one is to determine tax liability. You want to know how much tax is a company going to pay. All right. Okay. So the first reason is to determine tax liability. So to get your tax liability, you are supposed to multiply the company tax rates on the taxable profits. That's the one purpose of determining tax, of incorporating tax. The second one is to determine tax saved on capital allowance. Okay. To determine tax saved on capital allowance. So this is computed by multiplying the capital allowance rates on the, you multiply the company tax rate on the capital allowance computed. Then the third reason for incorporating tax in capital budgeting is to determine the timing of the cash flow. You want to know when is the tax liability going to be paid or capital allowance claimed. All right, so these are the reasons for incorporating tax in capital investments. Okay, now for the purpose of for the purpose or in finance, there are 4 types of capital allowance. The first one is initial allowance. Even though with the new tax reform, there is nothing like initial allowance again. All right. So initial allowance is an allowance claimable once in the lifetime of the asset. Once the company claims the initial allowance, you can't claim it again. So it is only once in the lifetime of the asset. The second one is annual allowance. Annual allowance is an allowance claimable every year until the final disposal of the assets. Okay. Then number 3, I can merge 3 and 4 together, which is balancing allowance and then balancing charge. So balancing allowance or balancing charge represent the difference between the tax written down value from the preceding year and then the sales proceed. Okay, let me rewrite it. Balancing allowance and then balancing charge. Balancing charge. BC. Let me write it. This represents okay, the difference. This represents the difference between the tax written down value, tax written down value from the preceding year, and the sales proceed, all right. Sales proceed is the same thing as scrap value. Okay, so it will be balancing allowance, all right. It will be balancing allowance. Let me put it down. It will be balancing allowance if the tax written down value from the preceding year is greater than the sales proceed. Let me see what I wrote here. If the written down value from the preceding year is higher than the sales proceed at final disposal of the asset. Okay, that's fine. All right, that's fine. On the flip side, let me push it down. Yeah, sorry for keeping you waiting. It's my network. I don't know. Let me just, we're almost there. Let me just finish up so that I can release you. Sorry once again for keeping you in the waiting. Okay, so like I was saying, it will be balancing charge, right? It will be balancing charge if the tax written down value from the preceding year, all right, from the preceding year is lower, right? Is lower than the sales proceed, all right? Okay, so that is balancing charge. Let me bold it. It will be balancing charge. Okay, this one will be balancing allowance. All right, so that's that. Let me remove this one. Okay, so that is that. Now, what are the methods? What are the methods of calculating capital allowance? There are two methods. We have straight line depreciation method. We also have reducing balance basis. Straight line depreciation simply means the same amount of capital allowance for all the years until the final disposal of the assets. Reducing balance basis simply means you are going to multiply the capital allowance rates. Okay, you multiply the capital allowance rates on the tax written down value for each year until the final disposal of the assets, when you are going to compare the written down value with the sales proceed. Okay, so that's that. Then the next one is the timing of the cash flow. When are you supposed to pay your tax liability or claim your capital allowance? Tax liability can be paid or capital allowance claimed in the current year, that is when the profit is earned, or in arrears, that is after 12 months, 1 year after. All right. If in a question examiner is silent, you are not told whether tax will be paid in the current year or in arrears, you are going to assume tax will be paid in the year profit is earned. But if you are told that tax will be paid in arrears, it means the profit of year 1 will be taxed in year 2. The profit of year 2 will be taxed in year 3. The profit of year 3 will be taxed in year 4. All right, that is what is meant by arrears. Okay, now what is the reason for claiming capital allowance? The essence of capital allowance is to reduce taxable profits and, in effect, tax liability. You want to reduce your tax liability. That's why you are claiming capital allowance. Okay. Finally, under this, how do you calculate? All right. How do you calculate tax saved on capital allowance? How do you calculate tax saved on capital allowance? What did I write here? Tax saved on capital allowance can be used to reduce tax liability and okay, let me just leave it. Now, to calculate tax saved on the capital allowance, this is the format. Now, remember what I said. The essence of capital allowance is to reduce taxable profits and, in effect, tax liability. So I can either use capital allowance to reduce my tax liability, or I use tax saved on capital allowance to reduce my tax liability. First thing first, if I want to use capital allowance to reduce my tax liability, I will first of all calculate capital allowance using this table. Year 0 will be the cost of the assets. Let's say the cost of the asset is 1 million naira. So here I will put 1 million naira. Year 1, my capital allowance, I will, depending on whether you are given initial allowance or annual allowance rates. So if you are given initial allowance rates, you multiply initial allowance rates on the cost of the assets. You keep it on one side. You also multiply annual allowance rates on the cost of the assets. You add the two together, then you deduct it from the cost of the assets. This will then give you the tax written down value at the end of year 1. We move to year 2. You multiply annual allowance rates on the written down value. On this format, we are assuming reducing balance basis. All right. So I will just multiply annual allowance rates on the written down value of the preceding year. I will get the capital allowance for the current year. I will find the difference to get the written down value for year 2. Let's say this asset will have 3 years life. So 3 years, year 3 is the final year. So to get my capital allowance for the final year, I need to compare the written down value from the preceding year versus the sales proceed. Sales proceed is the same thing as a scrap value. Okay. So I will then compare the written down value with the sales proceed, whether it will result in balancing allowance or balancing charge. If the sales proceed is less than the written down value, it is balancing allowance. But if the sales proceed is higher than the written down value, it is called balancing charge. So if I now want to calculate my tax liability, I will pick my capital allowance of the first year, capital allowance of the second year, and then capital allowance of the third year. I will deduct it from the profit of the for the years. So that will give me the taxable profit. With the from the taxable profit, I will then apply the company tax rate on it to get the tax liability. But I don't usually use that. I use tax saved on capital allowance to reduce my tax because this one is more straightforward. If I'm using capital allowance to reduce tax liability, I will have 2 stages of my calculation. So that's why I like to use tax saved. So everything is on the screen. I can see it when I'm solving it. It's on the same page. All right. I don't need to be switching or to be doing multiple workings. All right. So to get my tax saved on capital allowance, I will multiply company tax rate, CTR, company tax rate on the capital allowance I calculate in the first year. I will get this. Company tax rates on the capital allowance of the second year, I will get tax saved for the second year. Company tax rates on the capital allowance on the third year, on the final year, I will get my tax saved on capital allowance. This will be positive or negative. All right. Depending on whether it is balancing allowance or balancing charge. Now, the capital allowance, the total tax saved should not be more than the capital allowance claimable. Therefore, I need to go and confirm using this formula. Okay, I will use this formula to check whether I've not claimed more than what I'm supposed to claim. So to get the total tax saved is computed as the cost of the assets minus the sales proceed, then multiply by company tax rates. So that will determine the total capital allowance claimable. When you add up all of this, it should not be more than what you are supposed to claim. That's what I'm trying to say here. So to do that, to confirm that, you are going to calculate cost minus sales proceed, then multiply by company tax rate. So whatever you have using this formula, and the total of all of this must be equal. All right. So by the time we begin calculation, you will see the wonders. Is very straightforward and easy. All right. So finally, let me give you the format for calculating NPV. This is end of it all. All right. Anytime you want to calculate net present value or internal rate of return, all right, this is the format you are going to use. Okay. Formats for, let me do it this way. When there are multiple variables, including sales, variable cost, let me shorten it because of time, variable cost, incremental or attributable fixed cost, right? Initial outlay, working capital. When you have all these multiple variables, working capital, scrap value, okay, scrap value, inflation, taxation, etc. When you have all of these multiple variables, then the formula below, when there are multiple variables, the format below should be used to calculate NPV or internal rate of return. Okay. What are the formats? Very simple. Once you master the format, you are good to go. Just master the formats. All right. let me see. Let's say this project has 3 years life. All right, let's say the project has 3 years life. So description, year 0, year 1, year 2, year 3, then workings. All right. So let's say this project has 3 years life. Year 0, year 1, year 2, year 3, then workings. Okay, so let me see, calculating net present value, NPV. Let's say our figures are in millions. Okay. Therefore, I will go to the first item you are going to have in the format will be your sales value. I will go to the question and check if I'm given selling price. So if you are given selling price, you go you go to the question again and check if you are given inflation rates. So if you are given inflation rates, you inflate the selling price, you multiply with number of units sold. That will give you total sales. You then come and post. So that will be working number 1. I will go again to the question and check if I have variable costs. If I'm given variable costs, I will do the same thing. I will check from the question if I'm given inflation rates. If yes, then you inflate the variable costs. All right? You inflate the variable cost, you multiply with number of units produced, then you come and post. That will take us to working number 2. That's working number 2. Then I will check again from the question in case I'm given incremental or direct fixed cost. Incremental or direct fixed cost. Any relevant fixed cost. I will check whether I'm given inflation rates. If I have inflation rates, I will just inflate the fixed cost. All right. Then, of course, let me adjust for this. After this, I need to determine my profits. All right. I will then determine profits, taxable profit. Like I said, I like to use tax saved on capital allowance to reduce my tax liability. Therefore, because everything will be together on the same page, so I don't need to be doing multi-stage workings. All right, or calculation. So this will then be my taxable profits. On the taxable profits, let me bold this. Whatever is my taxable profit, I'll put it there. All right. Sales minus variable cost minus incremental fixed cost and any other relevant cost. When you are calculating this, you have to apply the relevant costing principle. All those things I was telling you the other time. How to treat variable cost, fixed cost, incremental fixed cost, depreciation, scrap value, historical cost, sunk cost, and all of the opportunity cost, working capital. This is the time for you to apply them. Okay. So I will put my taxable profit there. This is my taxable profits. After taxable profits, I need to pay tax. I will then say tax multiplied by company tax rates. In the question, examiner will give you company tax rates. So this will be company tax rates on the profits. Let me just put it this way. Company tax rates multiplied by profits. So the taxable profits multiplied by company tax rate will give you the tax liability. I will then go to the question again and check, how am I going to pay my tax? Is tax paid in arrears or in the current year? So you have to determine that from the question. In my own case, I'm assuming that tax will be paid in the current year. So that's that. Next one. After tax liability, then I need to claim tax saved on capital allowance. I will then say tax saved on capital allowance. So I will go and do my working. I will do my working here. Whatever I've calculated here, okay, is what I'm going to post. That's what we post here. All right. So that will give me tax saved on capital allowance. I will post it there. That will take me to working number 3. All right. Then after that, but if I'm using capital allowance to reduce my tax liability, this is not the way I will solve it. I will pick the profit that I have here, all the profit I have here. I will go and create another table somewhere. I'll pick the profit that I have here. I will deduct my tax liability. Sorry, my capital allowance. All the capital allowance I've calculated here. All this capital allowance, I will deduct it from the profits I've determined here. Okay, so that will then give me taxable profits. Once I get the taxable profits, I will then apply company tax rates on the taxable profits. Whatever I have there will then be my tax liability that will come and post here. So once I'm using capital allowance, I will not use tax saved on capital allowance here. Sorry, I will not use tax saved on capital allowance because I'm using capital allowance itself to reduce my tax liability. Whichever one you do, you are going to get the same answer. So next one is scrap value or sales proceed or net realizable value, whatever the name you call it or examiner has called it for you. So this will occur at the final year of the assets. So this here is the scrap value. Then after scrap value, you go to the question again and check, of course, what's the initial outlay as given to you. All right, the initial outlay is a cash outflow at the beginning in year 0. So put it in brackets. All right. Next will then be working capital. Working capital, you go to the question and check if you are given working capital. All right. If you are given working capital, you check, is there any inflation on working capital? If there's any, then you inflate, you get your incremental working capital. But in this particular format, we're assuming that we are given a one-off working capital in year 1. So this should be treated as cash outflow in year 0. Then at the end of the useful life, we'll recover the working capital. So we'll recover the working capital here. Then, of course, I will then find the total. This will then be the net cash flow. This will be the net cash flow. Okay. So here will be net cash flow. Let me copy this. So that's the net cash flow here. Let me make it double X. Okay. All right. So after net cash flow, you then discount. You determine your discount factor. So whatever is your discount factor, it is possible at times you may be the one that if you are given real cost of capital, you need to go and calculate money cost of capital and then come and post. So you multiply your net cash flow with the discount factor to get the present value. All right, whatever it is, come and put it here. Let me use this one, single. So you put your present value of cash inflow and present value of cash outflow. So the difference will then give you the NPV. The difference is NPV. Let me create another line. Okay. Let me make it 3. Okay, that's okay. Let me finish my table. In 2 minutes time, we'll be done. Okay. This one should be in the middle. So to get my net present value, net present value, I will then find the difference between present value of cash inflow and present value of cash outflow. That will give me NPV. So my NPV could be positive or negative. All right. NPV could be positive or negative. All right. So that's that. This is the format. Like I said, you use this format if you are given multiple variables. All right. That's when you use this format. So you have to master the format. So that's the end of it. Let me know if you have any question for me so that I can release you. There is God. Of course now. There is God. It is an allowance pay once. Okay. All right then. So any question for me so that I can release you? Evelyn, talk to me.
Well, it's not really a question. Maybe I think maybe when we attach figures to this format, I think it will be more understandable because I'm just struggling to like get the format.
You are just seeing the format. You don't need to struggle anything. Just master it. All right. No matter how big is the question, it can't be more than this. The only difference, you can just have one or two difference of values that are not given in the question, or maybe one additional value. So in most cases, this value will be consistent with anything you want to do. This is a complete format. Just master it, read it through, master it, and that's it. So by the time we begin calculation, you will see the impact of it. All right.
Okay.
Okay. Let me see. Some of you have disappeared, but I still have a sizable number of you keeping me company. Thank you, Alimi, Anthony, Augusta, Biola, Chioma Udeze, Emeka, Imem, Evelyn, Ezine, Ahmed, Ansin, Kingsley. I can see Augustan, then I can see Joseph. Joyce is keeping me company. Kayode is there with me. Matthew. I have Festus. I have Uche Nega. I have Abiodun Oduwole. I have Olumide. Oluwafemi is there with me. Pelumi is there. Reginald. Shola. Valentina. Valtor. Shubomi. Then Zaza. Thank you, every one of you, for waiting behind and then keeping me company. So this is end of the explanation of capital budgeting decision. In our next class, by the grace of God, we are going to be having calculation, period, all true calculations. If I'm able to solve like 3 or 4 questions, that's okay. Different scenarios, including the question tested in November 2025 diets. All right. So if I'm able to solve 3 or 4 questions, I'll be fine. Okay. If I have time tomorrow, like I mentioned earlier today, if I have the time in the afternoon, I will let you know in the morning that if we are going to meet in the afternoon so that we can begin calculation. Then when next we meet on Monday, next Monday when we meet, we are going to be rounding up. All right, we are going to be rounding off on capital budgeting. Okay, so thank you everyone. I will see you next time by the grace of God. Good night. Bye-bye.
Good
Good
night.
night.
Good night, sir.
Good
Good
night.
night, sir.
Yes, sir.
Good night, sir.
Night.
Good night, sir.
Good night, bro.